All right, Ken Peng is now joining us. He's Asia Pacific Investment Strategist with Citi Private Bank. Ken, great to have you with us here on the program. Thank you very much. So where does all of this leave us? I mean, the jobs report, the big sell-off in U.S. equities, and of course, I mean, oil, which is rising, right, which kind of dashes any hopes for near-term disinflation. How are things set up?
And if the London Metal Exchange decides to ban Russian metals, then we'll probably have more pipeline inflation feeding through. So all these signs, like you mentioned about the jobs and the oil, that probably delays or slows down the roll-off in inflation. So support for more Fed hikes, for more Fed tightening, is stronger now compared to, say, a week ago. The only thing that's arguing in the opposite direction is bond market volatility, widening bond spreads, basically a significant decline in liquidity in the U.S. and global bond market. And so, the UK helped with that as well. But generally speaking, I think the bond market health is something that could be a bit of a wild card in the coming months, beyond just the data on employment and inflation.
What does this mean, Ken, for global equity markets, which in any case have been under pressure all through the course of this year? If rates are set to move higher and perhaps we could head into a recessionary situation in the US, do you see further headwinds for global equities?
Yeah, absolutely. Like the things that might convince the Fed to turn around earlier aren't going to be positive for equities. So when I talk about bond market dislocations, right, this is a clear example where we've seen credit spreads, CDS spreads widen, but they're not nearly at recessionary levels. So there is probably still more to come, and so these conditions aren't very conducive to positive earnings. And so, we're looking at 3Q earnings about to begin, this week, and it's the earnings themselves are going to be okay, but the outlooks are probably going to be much heavier.
Hi, Ken. Morning. I recall you stating, I think, towards the end of August, start of September, that rally that we saw from the June lows, that's likely to get sold into. Well, you got that right. US markets, they revisited those lows. But the Indian markets, luckily for us, we're still 10% above those levels. My question to you is, how much lower can we go in terms of the US markets? Do you see there's a sharper correction in store? Point number one. And what's your view on the Indian markets? Can we continue to outperform?
Sure. So very briefly, we're looking at the U.S. S&P 500 earnings per share. We expect that to contract by 10% in 2023 in a moderate recession. Yeah. So if we go beyond that, then it could be worse. But so that compares to about 7-8% consensus earnings growth from a bottom-up perspective. So that's a significant adjustment downwards. Even if we assume the multiples stay the same, roughly 15, 16 times, that's still another 15 to 20% downside from where we are now. So I think we probably will breach the pre-pandemic levels for the US. India has outperformed both in terms of currency and equities by a large margin, and a lot of that I think has to do with beneficial inflows, right? Because if you have a EM mandate, in India is kind of, maybe to a lesser extent Indonesia as well, these are the only markets that are absorbing inflows, and I think that's been driving part of that. So the foreign inflows have been driving part of that outperformance. So I think one of the commentators just a few minutes ago mentioned that the outflows have begun. I don't think it's a huge problem, but I think when the U.S. is under such pressure, it is very difficult for India or any other market to really to make gains.
Sure.
Right? So I think relative performance might still be okay, but I think absolute gains are going to be very difficult to make.
1 second, hold on. Did you say that if the multiples stay the same, there is a 20 to 25% downside from current levels? In the US?
15 to 20, yes.
Okay, so 15 to 20% downside in the US left. So we're not done with this, fall in the equity markets just yet.
Look, the equities never bottom before the recession begins, and we're pretty sure that we're going to have one. We're going to experience one next year, and when does the equity market bottom? It typically is in the middle of a recession, not the beginning or the end. And so, no, we're not there yet.
So basically, somewhere in the 2,000 handle on the S&P, Ken. Possible.
I think that brings us to about 3,000, not 2.
Sorry, 3,000. What am I saying? 3,000.
Yeah.
I was wondering.
29.99, 29.90.
Prashant, a couple of bulls got knocked down.
No, it's almost there. I don't know if you guys remember, Rupal Agarwal made that point. She was on and she was, she's a large asset manager. Her point was with regards to the US markets and consequently what happens to India. She's got the US call absolutely bang on because we are back at June lows. And I mean, if what Ken is saying comes true, you're close to 3,000, under 3,000, right? But with regards to what's happened here, it's been absolutely astonishing outperformance. Just 10% knocked from the
I think it's also
highs.
because how strong the domestic economy is and how much things are picking up here, right? But Ken, Peng, as always, thanks a lot for joining in and speaking to CNBC-TV18.
Thank you.
Have a great day. Well, that's our first voice on global equities coming through saying that things are not looking good. And perhaps an additional 15 to 20% fall is what you can expect in the US markets. India, of course, has been resilient. Let's slip into a quick break. On the other side, our entire research team will be with us to help us with the list of top 10 stocks. Stay tuned.